All right, we're live. Hey, welcome everyone. Dan here with Chief Experts, and I have the privilege today of being online with David Lupberger and Jerry Packer, and we're going to talk about the employee retention credit, which I had no idea what it was until David told me about it. So once he told me about it, it's like, yeah, I got to let you guys know about this, because if you've got employees, this is a big deal. I just got off the phone right before you guys logged on with a longtime client and a very close friend of mine, Jared Bamer in Seattle, who had said that, yeah, in August, his accountant mentioned it to him. And so he went through the application process. He's got $140,000. It's just like, oh, Merry Christmas to you.
Yeah, no kidding.
So that was pretty cool. And that's exactly what you guys are going to talk about today. So let me just real quickly, let me just share my screen here. And so again, you're going to talk about the employee retention credit, and just a little bit about David. David's a good friend of mine. We go way back. I mean,
way back.
We used to do, we did a lot of webinars together in the day, and just, we've had a good time together, and we're part of a mastermind group together, and just really enjoy it. And I've gained a lot from David's experience and knowledge, and hopefully it's vice versa. So,
yeah.
But when David told me about this, it was like, I got to tell you guys about this. So Jerry, who is going to be doing this presentation, is the president of Omega Accounting. So Jerry, maybe you could give a little bit of information about, your firm and what you guys do, unless that's part of your presentation. Maybe it is. We can just jump right into that.
And I just want to say, Dan, I appreciate the promotion. I'm actually the director of business development.
Okay.
So I am not the owner, although I wouldn't mind being the owner. I am not the owner.
Okay, got it. So cool. Well, let's just jump into your presentation here. My mouse is being funky. What's going on? Could it? All right. Oh, I'm on the wrong screen. Dummy. All right, here we go. Helps if you're on the right screen.
There you go.
All right, cool. So Jerry, just jump into it. Everybody that's on the call here, if on the meeting, if you have questions, feel free to type them in. In fact, if you wouldn't mind just typing in where you're from and say hi, I'd appreciate that. And Jerry, just have at it.
Okay. If I can add one thing, Dan.
Yeah.
Is that, this is kind of a 30,000-foot view of the employee retention credit.
Okay.
Jerry will review the program and the different elements and how to qualify. And if people have questions, please post the question, and we'll answer every question at the end of the webinar.
Perfect.
Great. Thank you. And David, is there going to be an email sent out?
Yeah, Dan, you're going to do.
Oh, yeah, I'll follow up with emails to everybody, and then I'll give them access to the recording too. So absolutely. So that'll be cool. And I was just going to say something, and I totally spaced on it. But Jerry, just have at it.
Okay. So Dan, just to make sure, so everybody just can see the screen right now?
Yes.
Yep.
Great. Wonderful. All righty. So everyone, thank you. As Dan said, my name is Jerry Packer. I'm the Director of Business Development at Omega Accounting Solutions. We have been around since 2007. We're located in Irvine, California. We are experts in tax credits. We've been doing R&D credits. Some of you might be taking advantage of the R&D credits, which we work with a lot of builders on. Because we do R&D credits, we were uniquely positioned to handle ERC credits when the CARES Act was established. We have, as I mentioned, been in business a little over 15 years. We have earned the designation of one of the fastest growing private companies in Orange County by the Orange County Business Journal. We are a top workplace to work in 2021, and we have an A+ rating with the Better Business Bureau with 0 complaints filed as of the last time I checked, which was a couple weeks ago.
Well, to say that you know what you're talking about would be an understatement, I take.
You've been
doing this a while.
And hopefully people will believe me today. No, I'm kidding. Yes, yeah. So we do know what we're talking about. We are an accounting firm. We are. Sorry about that. We do not do tax, and we do not do audit. So we've kind of specialized in accounting and tax credits.
Cool.
when the pandemic hit, there was something that called the CARES Act that was enacted by Congress in response to the pandemic. It created two mechanisms that were stimulus for businesses. And I'm not the youngest guy out there, and as long as I can remember, there has been government stimulus. I've talked to business owners who have said, I don't want anything, I don't want a handout. This is not a handout. This is actually a refund on wages you paid during to keep your workers employed during the pandemic. Now, as I mentioned, there's always been stimulus, but it's always been geared towards the big guy, towards big business. It was the banking industry, the automotive industry, the airline industry. This is the first attempt, and really successful at getting stimulus to the small business owner.
Nice.
It started out with PPP, and at the time when the CARES Act came out, there was PPP and the Employee Retention Tax Credit, or ERC. You could not do both. Everybody did PPP. Nobody really knew about ERC, so everybody decided to go PPP. Now, the Employee Tax Retention Credit is a credit is a refundable tax credit. It's based off of wages. It's actually claimed through the 941, which you normally file at the end of each quarter, declaring your wages that you've paid and the taxes. And what we do is we file an amended 941, which is called the 941X. Businesses qualify by quarter. So it's not done for a year. It's done quarter by quarter by quarter. So in a year, you might qualify for one quarter and not another. So it doesn't disqualify you if you don't qualify for, let's say, quarter one, but you do qualify for quarter two. There are two tests to qualify. The most widely known test is the revenue test, which I will get into. And the one that's really little known is the nominal disruption path. Now, the program is set up and it's all based around W-2'd employees. So if you have 1099 employees, they do not count. And you, as an owner, if you W-2 yourself, if you're a majority owner, and if you have family that work, so if you have a spouse or children that work for you that are W-2 or that are W-2'd, they do not get included in the calculation. So they're excluded. So 1099 and owners are excluded from this. Question?
I know. I had said, darn.
Yeah. Right.
Because I'm self-employed. My business, I don't have employees. So it's like,
again, this is geared towards businesses that have employees that kept their employees working during the pandemic. So it started out that it was a maximum of 100 W-2'd employees. You could claim up to 50% of the $10,000 in wages per employee per year. So in 2020, what all of that means is you could get a maximum of $5,000 per employee. Now, in 2021, there were several amendments made to the CARES Act, namely ERC. First one was that if you had applied and received PPP funds, you could now apply for ERC. Second is that it goes up to 500 W-2'd employees. But most significantly, the change that was made is that you could apply for up to $70% of $10,000 for the first 3 quarters. So what does that mean in English? It means this. You can qualify for up to $7,000 per employee for the first 3 quarters of 2021 for a potential total of $21,000. So if you've seen ads or you've heard ads on the radio about, get your $26,000, the way that comes up, or the way that the $26,000 is calculated, it's $5,000 for 2020 and it's $21,000 for 2021 equals $26,000. Now, in order to qualify for the max, your employees need to make a minimum of $20 an hour. And a full-time equivalent is considered 130 hours. That we don't really need to get into that because part-time employees also count. So their wages account. So if you W-2 part-timers, They will count. Two paths to qualify, as I mentioned. The first one is a decrease in revenue. This is the path that's a little more known than the second path. So how does it work? It's done on a comparable quarter basis against 2019. 2019 is always used in the comparison as the baseline. So let's take, for example, quarter 2 of 2020. Compared to quarter 2 of 2019, you have to show a 50% drop in revenue. That's not income, so it doesn't take expenses into account. It's just what you brought in, revenue compared to 2019. So that's a pretty good drop. You have to have been impacted pretty severely to show a 50% drop. Another amendment of the 2021 amendment that Congress did was they lowered the threshold. So the drop only had to be 20% in 2021 compared to 2019. So Q1 of 2021, you had to only show a 20% drop against Q1 of 2019. The same happens for Q2 and for Q3. There is no Q4 for 2021. Again, no Q4. The reason is Congress eliminated that to help pay for the infrastructure bill. So only Q1, 2, and 3 for 2021, with a maximum of $7,000 per Q1, 2, and 3. Now, you might do a back of the envelope calculation and say, "Wow, I didn't drop by 20% in Q2 of 2021 compared to Q2 of 2019." That's okay, because the government, the IRS, has given us an additional calculation that could be advantageous to business owners called the alternative quarter election rule, which means we can use different quarters as opposed to the same quarter of 2019 if it's more advantageous to you. So we might be able to use, let's say for Q1 of 2021, we might be able to use Q4 of 2020 if it's more advantageous and it can qualify you. So my point is, if you do a back of the envelope, you don't think you're qualified, don't be discouraged, because we could potentially qualify you using the alternative quarter election rule. All right, that's the decrease in revenue. The second path to qualify has nothing to do with revenue. Your revenue could have doubled or tripled or quadrupled, and you can still qualify for ERC using this path. The government's term is full or partial suspension of operations. That is misleading, because you don't have to have fully or partially suspended your operations. What you have had to have experienced was a nominal impact to business operations as a result of COVID or a government mandate that affected your business, typically stemming from social distancing, limited capacity, supply chain issues due to COVID, permit or inspection delays, reduced operating hours, limited amount of workers on the job site, employee training, et cetera, et cetera. So let me explain. So let's say, and I'm going to get this wrong because I am not in the trade and I don't understand how you guys actually do business, but I'm going to oversimplify this. Let's say I have a drywall company and I do a job, let's call it 10,000 square feet, and I bid it in 2019, and I know how long it's going to take, because obviously I've got some idea, because I've got to bid it and I got to know that I can make money. So I've got an idea of how much a square foot or 1,000 square foot or 10,000 square feet actually takes, how long that's going to take. So let's say in 2019, I do a 10,000 foot drywall job, and it takes me a week to do that job. But during COVID, because of either I can't get materials, or I can't keep as many, I can't put as many workers on the job. So I'm not as effective. So that 10,000 square foot job now takes me 2 weeks to do, or 3 weeks to do, because of something related to COVID. I've been nominally impacted by 10% or more. Therefore, I might have made the same amount of money, or I mean, I might have charged the same amount of money, might even charge double. So my revenue might be up. But because it took me 2 or 3 times as longer to do than it did before COVID started, I have a metric that I can show, that we can actually show. We can quantify it, and we can qualify you through that path. Other things are supply chain interruptions. Let's say you're delayed on a job because you're waiting for supplies that are being held up, either because they're sitting in a port because that has slowed down because of social distancing, or because your manufacturer has had to either suspend their operations, or they had to slow it down because they had to space out their manufacturing floor, or they had supply chain interruptions. So we can go upstream, and we can actually show that that there was supply chain interruptions upstream that actually affected you and created delays or made you less effective, that we can quantify. So if you have any questions on that, write them in the chat box, and we will discuss this at the end.
Yeah, and can I just add a couple notes to this?
David, feel free.
Yeah, because look, in all honesty, I don't know any contractor that didn't have some disruption of service. And it could be due to permit offices closed. You couldn't get inspections done. It couldn't be, you couldn't get permits approved. You couldn't get the permit. It could be inspections were delayed because inspectors were not going on site. As you mentioned, it could be waiting for materials because of 109 permit container ships sitting in Long Beach Harbor waiting to be offloaded, and they couldn't do it quickly due to social distancing. And you can help people with this, if you can show that you couldn't produce work in the same efficiency in 2021 that you did in 2019, you qualify.
Correct. So moving on. Thank you, David. Because there were so many changes to ERC, there are a lot of misconceptions, and I hear it over and over and over again when I'm talking with business owners. And that is, yeah, we looked into it, or we talked to our CPA, or we talked to our payroll company, and we don't qualify because business was up. As I just explained, and as David reiterated, that is not necessarily a disqualifier. I also hear we receive PPP funds, so we don't qualify. Again, that was changed, so you could receive PPP funds and still qualify. And lastly, we were deemed essential. We didn't shut down. We don't qualify. Again, not a disqualifier. So how do we work? You're going to be sent a link after this. And if you're interested, we ask you to fill out your information and submit. And one of our representatives will contact you. They're going to have about a 10, maximum 15-minute conversation with you and learn about your situation. They're going to ask you some questions, and they're going to try to identify any disqualifiers right off the bat. If they don't see any, they're going to walk you through our process. And should you want to proceed, we're going to send you a sales agreement or a service agreement, which you will execute electronically. We're then going to ask for a refundable retainer of approximately $750. Now, why do we ask for a retainer, especially if it's a nominal amount and if it's refundable? Well, that's a good question. The reason is because we want you to have skin in the game as the business owner. We want you to place a value on it. If you place a value on it, we're not going to spend all of our time chasing documents that we need to actually start the process. And once we start the process, we may have questions. So we're going to get our phone calls answered. We're going to get our emails returned. In the very beginning, we didn't charge a retainer. And we wasted a lot of precious time that we could be doing filing and doing analysis, as opposed to chasing down documents and trying to get answers. So we want you to have skin in the game. Once we go through the process, if we determine you do not qualify, you get 100% of that retainer back. So there's absolutely no risk. If we do determine that you qualify, we keep that money and we apply it against the fee that you are going to pay us on the back end when you receive your money from the IRS, from the Department of Treasury. You do not pay us before then. How do we get compensated? We charge a 15% fee of the credit that you receive from the government if you have 10 employees or more, again, W-2'd, not including ownership. We charge 25% for 5 employees to 9 employees, and we just can't do under 5 employees. Why? Because we can't make any money. And you're not going to do a job that you lose money on, and we don't want to do a job that we lose money on. We're just trying to cover our expenses on the 25% fee. Why? We have CPAs on staff. We have about 15 attorneys on staff. These are the people that go through the analysis, that do the research, that sign off on it before we actually file. So you can believe or know or have confidence that we are doing it correctly. And if you are to get audited somewhere down the road, that's slim chance, but it is a chance that we will hold up to an audit. So if we go through all of that, you sign the agreement, you give us the $750 refundable retainer. We're then going to go through document collection. This is stuff that you can, these are materials that you can get from your bookkeeper, your accountant, some of it from your payroll service if you're using a payroll service. The first one is we need P&Ls by quarter. So we need Q1, 2, 3, and 4 of 19, 20, and 21. If you do QuickBooks or any type of accounting service that you're doing or software that you're doing yourself, you can run this in about 10 minutes. Your bookkeeper can run it just as quickly. So can your accountant. Payroll reports. Your bookkeeper, if they're doing payroll, or your payroll service can provide you with those. We need, if you are offering as a benefit to your employees, if you are offering healthcare, we're going to need those monthly healthcare statements that show how much you're spending. Why? Because that's included as income, and that will increase the amount of the potential amount of credit that you can get back. And lastly, we're going to need your forgiveness applications, because we have to see how much you actually were forgiven against wages, so we can back that out of the calculation of PPP, so we don't double dip. Let me give you an example. $1 million payroll, you apply or you get PPP, you get $400,000 of PPP, and it's all forgiven against wages. Well, we have to deduct that $400,000 against that million. So now we're working on a basis of a payroll of $600,000. Again, so we don't double dip. The government does not like to double pay. So they gave you the money for PPP. They don't want to give you the money again for ERC. So we have to back that amount out. Next, once we get all the documentation, we start the analysis. We go through the revenue decline, calculation analysis, and then we go through the nominal disruption analysis through an impact analysis. And that means an interview with you on the phone, typically about 45 minutes to an hour, where we're going to ask you a lot of questions, because we have to be able to prove that you actually experienced nominal disruption. We know about other ERC providers out there that'll say, Mr. or Mrs. Business Owner, you claim you experienced nominal disruption? Great, sign here. And that's it. They're going to file it, and God forbid you get audited, you have no backup. And the government is not going to take your word for it that you experienced nominal disruption. They're going to want to see the analysis. They're going to want to see the backup documentation. So that's why we go through what we go through. Once again, if we determine you don't qualify, you get your retainer back. So there is no risk. Our responsibility are document collection, the calculation, the impact study, the filing of the 941s, an audit protection package at the end of the process once we've received all our money from you. Our timelines are anywhere from 2 to 8 weeks from the time that we collect the documents. So once we get all the documentation, the clock starts. 2 weeks on a short end because it's just a strict revenue calculation and we don't need to go into impact analysis. If we go into impact analysis, it is longer. It can be on the the tail end, like 6 to 8 weeks, depending on how complex your case is. Now, the government is taking anywhere from 6 to 9 months to get the refunds out because they are incredibly backed up. Last I heard, they had 10 million parcels they're trying to get through. This is not filed electronically. It is done hard copy through snail mail, and they've got to get through it all. So they are way backed up. Once we determine that you qualify, we will give you the option, should you not want to wait 6 to 9 months, to advance you up to 65% of what you qualified for. So let's say you qualify for $100,000. We'll give you the option to advance you up to $65,000. Are there fees involved in that? Yes, there are. We'll walk you through all of that once we determine that you qualify. And this is just an option. You don't want it? No problem. About a third of our business owners decide that they want the money sooner. They're willing to pay the points, and we get them their money. 2/3 decide that they want to just wait and they'd rather save the money. Not a problem. We just try to make that available to you. So on October 19th, if you look to the left side of the screen, on October 19th, there's a memo from the IRS talking about what they call ERC Mills. ERC Mills are these pop-up providers. It's created because this is so large and there's so much money involved in it. This is way bigger than PPP, to the tune of about 1.5 times the size of PPP. So it's created a cottage industry, and anybody can be can be an ERC provider. You do not have to be certified. You don't have to be accredited. Anybody can say they're an ERC provider. So because the IRS is so backed up, they're not approving or denying the 941s or the applications. They're processing them. So they're going to audit on the back end. So they've given themselves 5 years to go back and audit somewhere down the road. So a business could potentially deal with one of these ERC mills, be told they qualify for credits they don't, or be told that they qualify for the maximum credit of $26,000 when they might only qualify for $10,000. They'll get their check, they'll pay their provider whatever the percentage is that provider is charging, and that business owner thinks this is the greatest thing, like Dan was talking about, since his person that received the money, since sliced bread. Things are great, but that business owner could potentially receive a notice over the next 5 years saying, we want to look at your backup documentation. With us, it's not a problem. You're going to have the backup documentation. If they dealt with one of these ERC mills and they don't have that, that's where the problem starts. So if you are dealing with somebody else or if you want to look at somebody else, not a problem. We're not the only ones out there doing it. The only thing I would ask is, ask those people, how long have they been in business? What kind of experience do they have with tax credits? And what kind of documentation do you get at the end of the process? So Omega, as I mentioned, has been in business for over 15 years. We've done well over $500 million in tax credits. We have to prove that you qualify. So we take painstaking measures. And sometimes you might go, what are these guys doing? We're protecting you is what we're doing. So we might be asking a lot of questions, but there's a reason for that. We believe that the IRS is going to key in. They're going to see a pattern once they start doing the audits. they're going to see a pattern with different ERC providers, and they're going to single those ones out that they know are the ERC Mills. We are not an ERC mill, and we don't want to get included in that. So we're going to do it. And if they want to audit some of our work, God bless them. Let them do it, because we believe that our work will stand up to the audits. Now, the audits are just starting. We've just heard of the first few that are happening. None of ours yet, but they are going to happen. But again, it's going to be a very, 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 very small percentage, because the IRS just doesn't have the personnel. There were 11 million businesses that took PPP. There are going to be more businesses that actually take ERC. So while they're a very small percentage, we want to make sure that all of our people, should they be audited, they're going to have the packet. They can literally hand to the IRS and say, here, it has the calculations, has the narrative that talks about why we qualified you, and it also has all the government orders that relate to why we believe we qualify you. And of course, because we want to get the most for you, we are going to, be aggressive, but we're also going to stay in the confines of the law. We are going to make sure that it stands up to an audit, should you be audited. So I think we got through this in probably about 25 minutes, as David said. Cool. So now we're going to open it up to questions.
Can I piggyback what you had said, Dan? And so I've got two clients who've worked with you, Jerry, and one in Milwaukee, and they sent me a note several weeks back. They've qualified for a $52,000 payment, and a second company in Louisville, Kentucky. And I smile because he sent me, this is the too good to be true email. They qualified for a $71,000 credit in the first quarter of 2021 and a $77,000 credit for the second quarter of 2021.
Right.
And once again, this is for companies that kept employees working during COVID.
Right.
And it was put part of the CARES Act. It's there for you, and just make sure you're working with the right company. I just received both a phone call and an email yesterday from one of these pop-up mill shops, Jerry. And what the email said is, you qualify, contact us now to get your money. I'm a sole proprietor like Dan. I have no employees. They had done no research. We call this spam. And so my research with you, Jerry, showed that you guys have done the due diligence. So I can encourage that if people think they qualify, to follow up with you.
Right. And thank you for saying that, David. And for those of you attending, if you'll notice, I always use words like potentially or may. We don't say that you're going to qualify because we don't know.
Right.
And we're not out there. It says, get your $26,000. The stars have got to be aligned for you to get a full $26,000. Have we qualified businesses for 26? Yes. Rarely, though. Our average is about $14,000 per W-2 employee. And remember, we've done thousands of these. So some are less and some are a lot more. Some are up at $21,000 per employee. Some are down, in the hundreds, especially at the real large ones that paid their employees to stay home, and they only paid their benefits or something like that. So they might have gotten a lot less credit, but they're still getting some benefit from it. And if they have thousands of employees, because they can do that, there's a way to qualify businesses for a lot higher. My point is, we don't know if you're going to qualify. We'll never tell you you're going to qualify until we start looking into it. And that's why, if you talk to somebody and they say, oh yeah, you're going to qualify for $26,000, we know that. It's like buyer beware.
Yeah, that makes sense. Great presentation. And again, this is not for everybody. I understand that. And that's why the emails I sent out, I said, for employers with employees, a lot of my clients might have one or two employees. They would probably they would have to go talk to their own accountants and things like that. But if you have 5 or more, then you're ready to go. So you know exactly what to do and how to do it. So anybody on the call, if that fits your mold, go for it. I'm going to post the link here that you can, I think you guys should be able to see this. Yeah. So there's a link in there now where you could go to start the qualification process if you want to. I'll also send out an email to everybody. If you're on my page where you're watching this, there's a link right here too to start your application. So that'll take you to a page that you put some information in, how many employees. You'll notice that it, 5 or more. And then you can kind of just fill this out, and then they will, like Jerry said, they'll get in touch with you and start the process. So looks like you have this thing fine-tuned, to say the least. Does anybody else have some questions out there? I had Tom on. He said, "Oh, it's just his employees are his wife and his son-in-law." So, yeah, Tom, you want to talk? What? No, that wouldn't even qualify. Period. For anything. So don't even bother, right?
That is correct, because they are ownership.
Yep. Right. Yeah. So, of course, I'm not sure what Bruce is saying. Move from Ann Arbor, maybe move because he doesn't have enough employees, kind of like me, or have any employees. But yeah, I'm not seeing any questions. So if you have questions, feel free to reach out to me. I'll have the link up here so you can go work on the application if you're so inclined. And all I can say is good luck. I mean,
and to repeat that once they finish the application, you can turn this around in like 24 hours, right, Jerry? That your folks will look at the application, then set a time to contact the contractor to talk more.
Right. We'll get in touch with you within 24 hours. That is absolutely correct. And
Okay.
I'd be surprised if it wasn't, unless it's at the end of the day, I'd be surprised if it wasn't the same day.
Okay, cool. And for $750, totally refundable investment. I mean, yeah, that's I think that's a pretty safe bet.
And it is a bit of an accounting exercise, collecting all the data information. But man, we're talking 5 figures, potentially 6 figures. Please look at this. The credit, which is not a credit, it's actually a check. It's available if you qualify.
Correct.
So this is a pretty big program. This program been around for a while now?
It was introduced when the CARES Act came out, and I believe that was in 2020, but it was modified or amended in 2021, in the beginning of 2021, and that's really when it started. But it's kicked in the last, I would say, right around December, January is when. So it's been about a year that it's really been very, very active.
Okay. And the reason a lot of people didn't take advantage of it because most people thought that the PPP was the only thing they could do, or was that the case at the time?
It was the case at the time, right?
But then that changed. Okay.
Correct.
So a lot of people probably haven't kept up with that change or are aware of that change.
There's been a lot of changes, and yeah, it's been hard to keep up with all the changes, especially for laymen. But
and even for accountants, Jerry.
Well, it's funny because most accountants, I shouldn't say most, there are a lot of accountants that do not do this because they don't have the bandwidth. They've been dealing with forgiveness and all of that stuff. 2, they haven't kept abreast of the regulations. And it's interesting when I talk to business owners and they say, well, I want to bounce it off of my accountant, and they should. But I always finish with, let me ask you a question. Did your accountant call you and inform you about this program that can get you money? And typically they have not. So, and the reason is because they're not doing it. So
right.
A lot of times we will talk to business owners and they'll say, oh, my payroll company and my accountant told me I don't qualify because my revenue wasn't down. But they're not looking at the second path, nominal disruption. So we have gotten lots of money for businesses that were told initially that they did not qualify.
And I mentioned to you, Jerry, before we got online, I spoke with a company in Eugene, Oregon, and spoke with the bookkeeper. And I said, did you follow up? And she said, oh, we don't qualify. Our revenue increased. Just what you said.
Mm-hmm.
And I said, did your accountant mention the disruption of service? She said, no. And I said, please give your accountant a call back and ask about the disruption, the nominal disruption of service. Because look, I don't know any contractor that wasn't affected by this.
Right.
Yeah, in
That's
some
true.
form, some way or another. Yeah.
Yeah.
Absolutely. Awesome.
Well, very good.
All right. I don't see any questions. So you guys, thanks a ton for putting this on. Jerry, thanks for that information. I'll be sure
Thank
to
you for
let
the
everybody,
opportunity, Dan. Appreciate it.
you bet. I'll let everybody, I'll get them the link and kind of go from there.
Thank you, Dan.
So cool. Everybody, thanks for joining us, and we'll see you next time on the Designer Show. This is Dan.